So really what we wanted to do was to welcome everybody here. I think we're going to have you on mute and watch for you in chat as you come in with questions, if your questions come in while we're presenting, and then we'll figure out if we want to go off mute, if we want to do voice questions later on to make sure that we get the whole subject. But if they're coming in during the session, we'll do that. So we've got kind of a lot of material to cover here in deal terms and trends, and we wanted to start by saying, you don't need to know all this. You need to know the core concepts so that you'll be able to feel like you're a part of the discussion and feel like you understand the contract that you'll be entering into if you go ahead and do angel investing using the standard Series Seed and Series A terms. Here's the panelist introductions again. I guess as each person starts talking, they'll talk a little bit more about themselves, myself, longtime angel, and many other things. Jess came to me saying that her father and uncle had been doing investing for quite a few years and she wanted to get started. And Christopher runs, I don't know, Christopher, is it the second largest angel group in the country? And also has just come off of a role as the chairman of the board of the Angel Capital Association,
where I've met all sorts of interesting people from all across the country. It gives me a good perspective. So glad to be here, Jean. Do you want me to pick up now, and I can say a little bit more? I'm sort of a tech investor. Launchpad's a big group in Boston, 150 members. We move a lot of money and try to help as many entrepreneurs as we can, particularly female entrepreneurs, and have been cited a couple of times for making a big contribution to helping the female entrepreneur cause. And we're super proud of that. So it's a real honor for me to be here today, and I'm excited to go through this. So as Jean said, this is sort of complicated stuff, and you really don't need to be a geek all wonky about it to be a successful angel investor, but it is important to understand some of the fundamentals so that you kind of get how the pieces fit together and you can hold up your end of the conversation in terms of the different trade-offs and risk allocations. And what we're going to do today is really introduce you to a framework that will help you make sense out of this. There are a ton of terms in a typical term sheet, and we're going to help you put it into 4 different buckets and make a little bit more sense out of it so that you can hopefully retain it. That said, I want to make sure we're in the right solar system and the right galaxy and the right universe here. So these deals really tend to get done a couple of different ways. One is a traditional priced equity round where you agree on the price and the terms and you actually buy stock in the company. And the other way is a deal where you give them debt that is not intended necessarily to be paid back, but instead to convert into stock at a future date when certain conditions are met. And so we'll talk primarily today about the standard traditional stock deal and the concepts embedded in that, and then touch a little bit on the convertible debt topic at the end. As you can see in this slide, I think everyone should hopefully have a slide with 4 blue boxes on it. Equity is the standard for angels and VC deals. What I would say about this, why it's the standard very briefly is really that it's kind of a miracle when you think about how well equity works as a way of aligning incentives, right? So someone is undertaking a risky speculative venture and they don't have any assets, they can't really borrow from a bank, so they go to investors and they say, hey, listen, how about if you give me some money and I might lose it all, and if I do, those are the breaks, But if it goes well, I'll share my upside with you. You'll own a piece of my company. And equity is really kind of magical when it works. So we tend to lend money or give money to startups in hopes that it will generate a return in the future. And the challenge is that it doesn't work perfectly for every kind of company. There are some companies that are probably not going to go after a big enough market and grow fast enough to be a fit for this kind of rocket fuel. There are some companies that are going to have a business that is probably like a service business or a business that's going to be a very, very nice business and well worth pursuing, but probably going to accrue most of its benefit to the employees and the management team. So we're talking about.
Jump in for a second and say an example would be if you actually had something that really should be and it's a nonprofit. You actually usually can't merge those or have them acquired by other nonprofits very easily. And certainly not with a share of the assets going out to the people who provided the funding to help them grow. So there's just a lot of kinds of companies that aren't going to work out for this equity standard, but it's often easiest to learn the equity standard first and then deviate from it when it's appropriate to, rather than the opposite, because this is complex enough. So why put in 14 other versions?
Yep. And so the deals that, because of the nature of these deals, we give money on a sort of a no recourse basis in hopes that we'll be part of the upside. We tend to focus on companies that have big upsides. And often those big upsides are associated with real technology leaps forward. Tech is often at the heart of a lot of these companies, but not always. So I'll probably skip to the next slide. Go ahead to the next slide. So obviously, the actual deal terms are a contract, and there will be a number of documents: a stock purchase agreement, a disclosure schedule, an investor rights agreement, perhaps a voting agreement, and then a charter. And we'll talk about that. But those really lengthy documents come at the end of the process, and what you'll see. Most of the time when you're really trying to make your decision whether to invest is a term sheet, which in our world is typically not binding, but it is a nice, concise 2, 3, maybe 4-page summary of the key issues in the deal. And that term sheet is usually created when people have done enough diligence to get comfortable that this is a deal that is going to make sense for equity investors. And like I said, the term sheet is typically not binding, and the challenge for you is that although you don't really want to, you do need to be careful and make sure that you're plugged into the investor network and that the final deal documents you sign are materially the same as the term sheet. They almost always are, but you want to keep your ear to the grapevine, because the term sheet itself is just a summary of the deal and it's non-binding. Jean, anything you want to add, or Jess, on term sheets as a topic, or do we press ahead?
I think we can press ahead and say that today, the top of this slide says term sheets for Series A, and Series A certainly was the series of stock that we used to get first, but now we put in a couple of flavors before Series A. We call them Series Seed or Series Seed Plus or Series something else, as ways of talking about the amount. They often have to do with the amount of money.
Yep.
But Series A has just been used for a long time, so there's lots of case law around it, and there's other ways to see what's going on.
Yeah, I would say probably the takeaway for folks on the session here today is that the name doesn't matter as long as you have something to call it, and you're all talking about the same thing. There can be strong advocates on both sides of any naming question. It really doesn't matter what it's called as long as we're all talking about the same thing. So we tend to use Series Seed or Series A, or sometimes we'll even use Series 1. The point is, it's just one of the earlier, if not the earliest, preferred stock class is created by a company in the money raising context.
And folks, if you have any questions, be sure to type them, or if you need to ask them in words, wave your hands wildly and we'll unmute you.
Yep. And we may, if we have time, we may actually take you through a tour of a term sheet at the end. So as I said, I hope you all have a slide with a disgusting number of bullet points on it right now. And as I said before, these term sheets really cover a ton of different topics. And it's really quite daunting at first, but once you understand sort of how to group them together and what's going on, it becomes a lot more manageable. And that's our goal today, is to get you those groupings and get you oriented. And really all of these different kinds of things relate to just allocating the risks associated with different kinds of outcomes. If it doesn't go well, if it does go well, if one of the founders leaves, it depends. All these kinds of situations, and everybody's learned their lessons over time. And the term sheet is about identifying the key risks and allocating them as part of a negotiated deal. So you guys should all be excited, because at the end of this talk, all these bullet points are going to make sense to you. So that's an exciting thing. So you take that big list of bullet points and you realize that they basically boil down into 4 buckets in no particular order. One bucket really is terms that relate to the governance and management and control that the investors expect to have over the company. They're giving their money on a no recourse basis. They're saying, do with it what you can. You have no liability if you fail, but we're going to exert a little bit of control over you and help you not fail. The second bucket is terms that relate to investors' rights. Things around protecting our class of stock, making sure that we are given enough information, that we have a say in key decisions, and that we know what's going on. So that's the second bucket. The third bucket is terms that relate to how this company might be acquired or drive an exit, how people are going to get paid, how a liquidity event like that might be created, a number of different terms associated with what are we going to do at the end of this investment. And then the final set of terms are really just the deal terms, right? So how much money is being raised? How is the company being valued before the money goes in? Is there an option pool set aside? So a bunch of just deal terms are that final bucket. And angels will occasionally, if there's a bullet point on that first sheet that isn't in your term sheet, just keep in mind that angels sometimes try to keep it simple and leave terms out that just aren't going to be relevant at their stage of working with a company.
And in particular, when it's called a series seed, there's some norms to leave out or to signal with just a sentence or two, things that might be more complex in a true Series A round. So,
okay. Yep. So before I go to the next slide, just make sure people are tracking me, right? So we have all these terms. They're very intimidating, but we realize that we can kind of get our head around them if we think of them in buckets. So flip back to that next slide, Jean, and let's take a look at some of those bullet points in that context. Everybody should have a slide with 4 red boxes on them. And now we're beginning to take those individual bullet points and put them in a little bit more context. So for example, on the management and control bucket, that's where we're talking about things like, having a board seat or an observer seat in the boardroom, having information rights, whether or not the founders are going to be required to put their stock at risk in the event that they leave or sign non-competes. And then what the board and shareholder approvals are going to be for the various decisions the company is going to make as it operates. Going across to the right, the protection topic we talked about, This is where you're going to see clauses like anti-dilution, which is a neat magical term that we use to make sure that nobody gets to buy stock for less than we paid. Preemptive rights that allow us to participate in future deals. And we're going to go through all of these in detail. We're just trying to kind of map it for you. Rights of first refusal in future transactions, or co-sale rights in the event that there's a liquidity transaction. So that's where some of those things, they end up, and those are the kinds of things in the protection bucket. Jumping down to the lower left, the exit and liquidity, you're going to find terms like the drag along right, which is the right to manufacture a consensus. If a few people want to get out and think it's the right time to sell the company, you can't have a couple of lone individuals holding you up. So the drag along can allow you to bring them along. Registration rights we don't use those very often anymore in the angel world because they're the small IPO is essentially gone and never coming back. So registration rights give you the right to get your stock holding registered as part of the IPO registration. And occasionally you'll see deals with redemption rights, which is a right to, it's essentially a put right to make the company buy your stock back, in the year 5 or year 6 or year 7. And again, that's not something it's in most angel deals, but it does come up from time to time. Jean, I actually was just talking to a group in the Tahoe area that uses redemption rights in all their deals.
Yeah, I know some reasons in today's world to consider a light version of it back in.
Yep. I kind of feel like I'm moving in that direction, but we digress. The fourth bucket is this economics catch-all, right? And so we're looking at what is the instrument? Is it Series A or Series C preferred? Are there any discounts on the stock? What is the pre-money valuation? What is the liquidation preference in the event that the company has an exit? Are there dividends that run either in the background or accumulate? What is the option pool that is being set aside out of the capitalization for attracting, hiring, and retaining employees? And often a term sheet will sort of summarize the capital structure. So that gives you a little bit of a sense of how that mess of individual bullet points begins to map into the different buckets. And we are going to go through more detail, but let me just pause and check comprehension. Can you wave if you're terribly frustrated and concerned? Unhappy?
Put your thumbs up if you're okay.
Good. You're hanging with us so far. All right. So this is the most exciting stuff. So we're having a lot of fun, and we hope you are too. What's next, Jean?
I'm going to do a little bit of
Over to you.
Of review, and then head on into management and control.
Perfect.
So really, remember, this is a deal. We're signing a contract with the entrepreneurs, the people who own the company, and we're trying to make sure that it's a deal that feels fair to each other. It turns out that we register this deal with the Secretary of State in the state that the company is incorporated in, and so this is a deal that's watched over by the government to make sure that these deals all fit within some really wonderful Securities and Exchange Commission rules. And remember, it's a deal, so the entrepreneurs have different kinds of concerns too, and so those are the kinds of things that that they're thinking about. They're thinking about various types of losing control. What's going to happen if the company gets into various types of situations, and their own ownership, where they've usually put quite a bit of sweat in to get to where they are today. So really the most important thing is to find something that ends up being sort of a fit with the investors, so that everybody's pretty much on the same side. And that's what equity is supposed to do, is to have everybody focused on growing the size of the pie so that our piece of it gets a little bit bigger. These are the sort of core categories of management and control. Christopher went over them briefly, and we have a slide on each of them. And I'm going to say it again. You don't need to know all this detail. You just need to know what the basics are that are going on here, so that you understand that as a part of signing that big stack of papers, that is the deal, you understand the core negotiation concepts that have been included into it. So the most common thing is the right to elect a member to the board, or maybe even to define all of the membership of the board. So there might be it might be that this company is going to have a board in which there's two board members representing the common, 2 board members representing the investors, and a 5th sort of tie-breaking board member who will be acceptable to all the parties, right? So the board has to agree, yep, that 5th person, the independent board member, is acceptable to all of us and isn't actually looking out for the rights of somebody who's in the contract. Board observation rights are another issue. The board might be already filled. You might be happy with the board, but you want to have somebody in the board to be able to watch what's going on. Somebody's just getting unmuted. Is that right? Oh, getting muted. Okay. So you might have a board observer. You might have a board member and a board observer. You might have just a board observer. So all those will be defined in the deals. Any kind of confidentiality provisions, either around the deal or confidentiality as it applies to others in the situation, will be defined here. And board observers, for example, often sign a confidentiality agreement. If you're a board member, you have fiduciary rights. You have to you are responsible for that company. You don't have to be confidential. You've already got built into the law of being a board member a set of things that regulate you, and the terms. So lots of times it will say something like, this person will be a board member up until the next round comes in. This person will be a board member for 2 years, or whatever it says, and that's really what's going on in board seats. Uh-oh. There we go. Investor rights, really, this is where we say, what is it that the investor's going to get? So maybe you're going to get quarterly reports from management. Maybe you're going to get once a year reports of financial statements, or maybe you're going to ask for them more frequently. If you want to go in and review what's happening at the company, do you have inspection rights to go in? Sometimes you say things like, this company's gotten to such a complex state that we want to have it audited every year. Obviously, if we're only putting a few pennies in the company, we don't want to have them pay it all back out to auditors. So again, some of these things are often quite light in an initial angel term sheet, and then as the company grows and gets more complex, more of these terms tend to come in.
So Jean, Vermont wants to know if this applies to just corporations or LLCs as well. I'm assuming that was, I guess, everything up until this point. Is that what the question is? Yeah.
So you can run a an LLC to replicate almost everything that's happening in a corporation. So things like having an option pool, so having an economic right for the parties that are that are part of the company in another way. Say they were employees. All those things can be there's a way to do all of them inside of an LLC. The actual rights of the investors in an LLC are pretty easy to define, because an LLC is just that. It's a contract that doesn't have corporate law built in. It's just a contract that has its own terms built in. And so the rights of the investors are usually quite easy to express. Sometimes you get into a little bit of dancing around when you want to do things like give economic rights to employees.
Yeah, I would agree with you. You can do it as an LLC. It's a lot more work and a little bit more uncertainty in terms of the Delaware C Corp is just such a well-settled beast with so much case law and so much in the way of, inexpensive lawyer forms and everything, that everything can be done in the form of an LLC, but it introduces enough complexity, enough wrinkles, enough additional expense that most investors have a strong preference for using a C Corp. The pass-through tax nature of the LLC can be problematic because the losses and the profits get pushed down to the stockholders, and they can end up with, or the members of the LLC, they can end up with unfunded tax liabilities. So 99 out of 100 deals are going to be Delaware C Corps, if not 999 out of 1,000.
Yeah, another way to think about it is if the company has grown to where it is today as an LLC and it wants to take in investment, sometimes people will say, okay, we'll come in on a convertible note while you're a LLC, but you have to convert into a C Corp in time for the actual priced round, or you have to convert to a C Corp by the end of the year, or things like that. And again, if you ever want to bring in venture capital into it, it's going to be a really high growth company. You're going to have to be a C Corp, and it's a lot more expensive to convert an LLC that has a lot of revenue and stuff into a C Corp than it is to convert one that's maybe been an LLC during its life as a, just a development company, and then it needs to go, it doesn't have a whole lot of revenue and complexity. So in general, we suggest that people start out as C Corps and be C Corps, but if for some reason they are an LLC and it was the right thing to do, in most cases we suggest that they be able to convert.
Jean, we had a Secretary of State question. I'll take a quick whack at it, and you can keep me honest here. So do all these deals need to be registered with the Secretary of State? And the answer is that there are two forms of regulations that apply to these deals. One is national sort of federal securities laws, and these deals are all done pursuant to an exemption. These are sort of what's known as private deals. They're not generally solicited, and they're limited to involvement by accredited investors, who essentially are investors who meet a sophistication standard indirectly by virtue of having enough income to be deemed able to withstand the risk. So these deals are not really regulated at the federal level. They're done under an exemption, and you do make a quick filing with the SEC called a Form D, which just lets the world know the company raised money. At the state level, because you are creating a new class of stock, most states, all states, especially Delaware, do require you to file the rights and responsibilities of those stockholders in an updated version of your charter with the Secretary of State. So a lot of the terms that we're talking about today, they get sprinkled across different agreements, but a lot of them end up in the updated charter that is a public document filed with the Secretary of State. And when we talk about this idea of a deal closing and the closing happening, one of the things, the money gets all lined up and all the signatures get collected, and one of the things that's happening in the background is someone is filing an updated charter to say, hey, this company, file number whatever, has this address and this place to send notice, and they have a class of common stock and they have a class of preferred stock that has these rights, and that is a public record, which goes back to before the turn of the century. Does that answer people's questions with enough detail? Keep going.
Yeah, I'm gonna add one more to answer to that question, which is during the period that you're in a convertible note, you don't do that filing, and so that is actually one of the things that happens if you're trying to roll in money over time. You don't have to have the cost of going down and filing with. It's not very expensive, but you don't have to have the cost or the hassle of going down and filing anywhere. So another thing in management and control, sometimes people say, hey, the founder needs to put some of their stock under ownership in a way that they vest out, so that the founder's going to be focused on staying. Lots of times people use the Zipcar case to talk about this problem. The two founders of Zipcar had equal shares. One of them worked herself to the bone, 70 or 80 hours a week for 2 to 3 years. The other one kept the day job and showed up to a meeting once a week. And at the end of the day, was it fair? And had the investors forced them to put their stock under vesting, probably they would have stopped the vesting of the non-active founder.
Yeah, I'll give you all a little pro tip, right? So we talk about this concept, we call it founder vesting. In point of fact, it's actually the lapsing of restrictions, right? The founders own their stock, and we come in and we say, you're going to sign a contract that says if you leave the company, for some reason other than cause, or even if you're fired or you leave the company, you will leave some of your stock behind, because if you took it with you, it would be incredibly dilutive to us to have to go replace you and give new stock to someone else. And potentially we'd have a dissident shareholder running around who owned a big chunk of the company. So we ask them to sign an agreement saying, if I leave, I'll give up my stock. And those, we call it vesting, but it's really the lapsing of clawback restrictions over time.
Yeah. So you're getting too much inside baseball, Christopher. They don't need that level of detail.
They don't need that.
We can just call it vest.
All right. Call it vesting, but just know it's restrictions lapsing.
Okay. And sometimes you're going to be insuring somebody who's absolutely critical to the company. Yep. And so these are all these little details. I have to say this is the one term that founders hate more than any other term.
Yes, they really don't like this one, even though they understand it. I don't know why they don't.
Yeah. Any other comments you want to drive in there, Jess?
I guess this is. One thing that we're going to be talking about here is sort of the standards that angels use. And one of the things that Christopher mentioned is that oftentimes there's follow-on funding, and we'll have terms in here that we know the next round is going to want to see in the term sheet as well, and protections. And, the non-compete is in here. This is a coast-to-coast thing, and it depends on state to state too. Mass still has it in quite a few of their deals, and VCs still stick it in. Key person insurance, that's usually standard too. We'll talk about trends later on, but most of these are standard.
Yeah. So, and again, some of these things are things where you say to the founders, hey, I bet the angels will only make you have 2/3 or half your stock vest. If you wait till the VCs come in a year, they're going to make you vest 3/4 of it. So get on the horse fast. So those are some of those things. So board and stockholder approval rights are some of this is going to show up again over when we talk about protection, but this is really the story that says, there's some things that the investors have decided should not be allowed to happen without them knowing about it. And so sometimes you'll get a notice that says, hey, the company has decided that it needs to add some more, stock to the option pool or something. That's a dilutive effect to you, and you need to know about it. And so in general, things that are going to require a significant change in the rights of the investors require some type of approval from either the board or the shareholders. And part of the magic of the deal is divvying them out to the right party so that they get taken care of correctly. occasionally there'll be something that says 2/3 of the preferred holders need to approve this or it can't go ahead. And that will be another thing. So it's not just a majority. So again, these are all sort of inside baseball and probably not something you need to worry about a lot, but they are things that you will find people debating or having an opinion about.
And there are, I was looking at something, oftentimes it'll be specifically the Series A board members' consent for certain things too.
That's right. Sometimes it'll say, unless the Series A board members consent, then such and such can't happen. So it'll be very detailed. So I think
exits of liquidity, Jess. You wanna lead us off on this?
Excellent. These are all two of these are quick talks, and actually all three of these are fairly quick talk. I get the quick talk section. So all of these are put in place specifically rights for the investors in case of two things. In case there's an exit or a liquidity event, or in case there isn't an exit or a liquidity event in the case of redemption rights. So drag along rights, this basically is a fancy way of saying if the majority of the board, if the board agrees and the majority of the preferred and the common stock approve of an acquisition or a merger, change of control, then all of the shareholders agree to vote along with it, the transaction. And this basically prevents a single small shareholder from holding out and thumping their foot and preventing a sale. Also, sometimes small common shareholders too. So the affected shareholders in this case are pretty much all the preferred stock and most of the common stock, the founders and holders of a greater than a certain percentage of stock. And all common. So this is pretty much affects everybody with the drag along rights. And this is always included in all term sheets because you want to make sure that everybody comes along with you. Registration rights, this is usually one sentence in a term sheet, and it basically usually says registration rights as seen in usually the NVCA or the standard registration rights, at least in the term sheet section. This is more complex when you get into the closing docs, but it's pretty straightforward in a term sheet. And it just basically is, you give the company the right to have the company register common stock when the preferred stock is converted in terms of for an IPO. Hey,
if you're so lucky to have an IPO.
Yeah. Awesome. But that's really all that says. It's very short. And then redemption rights. Now, redemption rights come in and out of favor with term sheets. They have been coming back into favor. Sometimes they're just in there because people will just rip something from the NVCA and it's automatically in there. Oftentimes what the redemption is and why it's in there is that it's basically if you have a company that's kind of kicking along, doesn't look like it's going to be acquired, but it's doing okay, and it can possibly buy back your shares, you basically trigger this and you say, buy back my shares because I want to get some sort of liquidity out of you. And you can continue with the company, but I don't need to have the equity in here. It's not often used. It's very rarely triggered. So you won't necessarily see it. Sometimes it's tiered. You can take a certain amount out after a certain number of years and so on and so forth. It's usually 5 or 7 years after closing that the you can deemed when the redemption event could happen. And I've only had one company that's ever really cared about this enough to worry about it 5 years later. And that's one that actually Christopher and I are both in.
I'll add a little note of realism or cynicism here. So you invested because you thought the thing was going to grow like crazy, and it's doing great, but it isn't growing as fast as it should have. And in fact, enough years have gone by that the slow growth rates become a problem in terms of trying to bring more money in and really get the thing to take off. And so you're sitting here not getting any return, but the management team's getting paid every year. They're getting nice salaries. And so the redemption rights window is essentially a put right that allows you to manufacture a crisis and say, I demand that you buy my stock back from me, which typically means the company's going to have to either distribute a lot of cash if they have it or go find some cash. So it's a way of forcing a conversation around, hey, you're the only people getting paid here. Give me my money.
Yeah. And you don't see it triggered too often these days. And although they are coming back into fashion, I've seen quite a few term sheets with it on these days.
Okay, so I'm going to try to get us to move a tiny bit faster, and it's not just so that we have plenty of time for questions, and just to see how people are feeling. So if you have questions, be sure to type them in or wave your hands wildly, and we'll unmute you. We're just nervous about background noise if we have too many people unmuted. So these are the protective rights. These are really the things that pretty much say what is it that is going to protect your rights in the future. And again, sometimes they're allocated to decisions by different parties. So anti-dilution is something that says if the next time that the company sells stock, it's less that it's priced at a lower price than what we just paid. We paid $1 a share. It's about to sell it for 50 cents a share. Then there's a way to calculate a system that makes sure that the person who invested at $1 a share, in essence, their stock gets repriced at some weighted average of the two prices. So it may be that extra stock will be issued to them, whether or not they participate in the next round, as a way to make them closer to whole to what they maybe should have paid. Instead of the $1, should have paid 50 cents, maybe they get enough stock that it would have been the same as if it had been 75 cents. So it gets issued to them as a part of the deal going down.
And it's a very complex formula. If you ever look at it on the term sheet.
Yeah, don't try to do the arithmetic.
Don't worry about it.
Unless you had a math major or you just want to suffer. It's not really that hard, but it just feels hard. And then the first right of refusal is something that says, okay, some founder is leaving the company. They want to sell back their shares to the company. Who gets it first? Should it be other founders? Should it be other employees? Should it be investors? And all that is just defining who it is. It doesn't really matter which answer it is. It matters that there is an answer, so we're not in a complex, don't know what to do here. And that's, like all lawyer stuff, it's trying to define oh, that's a good one. We're back on the
formula.
Yeah. Well, the formula is in the term sheets, and so in advance what it's going to be. And again, like I said, if it's something like weighted average, you know that you're going to buy the total number of shares by the total number of shares that are being sold now, blah, 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 blah. Basically, it's a formula.
Yep. You can look it up. It's on a number of different websites. It's standard.
Everybody monitors it, because if you're going to do a dilutive offering at a lower price, you require the shareholder consent. Yep. So we all get the heads up. We all have an opportunity to monitor it, and somebody really smart in the investing consortium will monitor it for you. So, Jean, I think of the ROFR and the co-sale as sort of flip sides of the same coin, right? If it's growing really well, things are going well, and someone's able to sell some stock, I want the right of first refusal to buy it, right? It goes to the company. But if things aren't going so well, and some rat manages to get off the sinking ship, I want a right to sell my shares as well.
A long time.
That's right, and so that's actually the two things that are going on in first refusal and co-share. So Christopher said it absolutely right. I don't think we need any more seconds on that. It's pretty simple. And then there's a participation in future financings clause that usually comes in that says, hey, you're allowed to buy up if what you bought the last time had you ending up owning 1.5% of the company, and there's a new round offered, you get to buy 1.5% of the new offering. And there's various ways to calculate it. Usually we're trying to get people to put in more than their true pro rata rights, so we have a fair pro rata that we send around.
And you said the magic word, Jean. This is often the nickname for participation is often called pro rata rights.
Yep.
And it's really just a nickname because of that term, pro rata.
Means you can.
So I have a question on here. What would be a red flag in a term sheet? So I don't think we've crossed things that are big red flags yet, Janice. So why don't we wait till we get a little further down, and we'll say the ones that really drive us nuts or make us feel like somebody shouldn't do these things. And again, like we said, we're really trying to give you guys the basics so that you understand the contract that you're getting to be a part of, even though we don't actually think you have to know all these details. We think you need to know the big buckets. Hey, I need to have my rights protected. I need to know who's in charge and who's doing the management. I need to know other things.
Though I would say that anything that deviates from the norm, which is really that NVCA document or what we're talking about, would be a red flag. I've seen deals tank because the founders refuse to revest. I've seen deals tank for a number of different reasons. But if the founders are really putting their foot down about any of these items that are important to us, that's a red flag.
Yeah, that's probably true.
All right, on to economics.
Yep.
So obviously the key term here, and this is one of the hot button issues or one of the red flags, is when you are putting money into a company, you're buying a share of the company. How much of the company you're buying for your dollar is a function of what the company's valued at when you do the deal. And it's often referred to as the pre-money valuation. So for example, if you're giving the company $1 million and their pre-money valuation is $3 million, afterwards, the post-money is $4 million, and you own 1/4 or 25% of the company. So the
Let me get the right
valuation term is an important one, because if you value the company too high, you own too little of the company and too little of the upside. It may also be hard for the company to raise money in the future. So to Janice's question, pre-money is definitely one that gets discussed a lot. The founders want it to be high and the investors really want it to be low. And it can be complicated a little bit by the fact that we typically specify that just like when you buy a car, you want it to have 4 tires and seats and a steering wheel. When I buy part of a company, I want it to have an option pool because I want that company to be able to attract and retain talent in the market. So I specify that my $3 million assumes that the company has set aside 10% of their stock for an option pool or more, so that it'll come out to 10% afterwards. And so that has the effect of being even more dilutive on the team. Jean, you want to go into any more detail on that, or are you good?
No, I think we're good. And again, just to give people this idea that the money that's coming after you has a strong opinion about how the revenue and the price, the valuation, are lining up. So if the company's going to be only making, $250,000 of revenue, and they've got a post-money valuation of $5 million, those two attributes don't line up. So you have to be looking to make sure that the next set of money is going to like the deal, and they're going to be thinking about the revenue. You're going to be thinking about revenue too, but it's even more important when you think about the next round.
This valuation question is so important. It's probably worth investing 30 more seconds on and just giving you a very simple frame of reference, right? So if we value it at $3 million, we put $1 million in on Monday morning, clearly the company is worth $4 million because we agreed it was worth 3 at arm's length, and then we put $1 million in cash on the balance sheet. Then the company's going to go and they're going to spend that money on people and product and progress. And one day that money's going to be gone, right? And the question is the company still worth 4 million without the million on the balance sheet? And if they're not, then either I did my job wrong in valuing the company when I did the deal, or the founders did something wrong in their execution, or both. But if that happens, the new money can't come in at 4 million or greater, which means you get into all these things like the anti-dilution protection and all these kinds of problems. So getting that valuation right is the most important thing that we do.
And getting the entrepreneurs to agree to it.
Helping them figure it out.
Yes.
So I'll say this on liquidation preference. Remember how we talked about going down to Delaware and filing a charter? One of the things about preferred stock is that it has the right to be paid before common stock. So after the company pays its taxes and its payroll and its creditors, the next people to get paid are the preferred stock. And preferred stock can be customized in a million different ways. And one of the ways you can customize it is to specify, not only do I get paid first, but I get paid a little bit more, I get paid a little bit differently. Normally in our world, we keep that super, super simple. And we don't specify that, for example, we get 2x. We simply say straight 1x liquidation preference, just meaning that I have the option of either getting my money back first if it's a crappy situation and there's not enough to go around, or if it's a great deal, I just convert into common and I take my share when it gets paid out. Occasionally, we will see complications like a stock that has its cake and eats it too. It gets paid and then it goes back and gets in line with the common. That's called participating preferred. Probably don't need to spend a ton of time on that, Jean, unless you want to.
Okay. So Maine has asked about a so-called lifestyle company, which I think I had on a slide earlier, which mostly means that the company is not going to be probably eligible for being acquired and therefore not having any way to exit. And so in general, it's just a way of saying probably it's a slower growth company. It's probably paying its bills and maybe even kicking off a tiny bit of cash, but it's less likely to be focused on high growth and therefore being able to be combined well with some other company, which is what we're trying to do in an exit. We're trying to have this company combined with another company in a way that everybody gets paid.
It's providing a good lifestyle for the management team, but it's not doing much for my lifestyle.
Again, there's a category called dividends, and sometimes they get turned on, sometimes they don't. We would strongly urge that they not get turned on. You may want to declare the rights around dividends. But again, this is this idea that the company is renting the money and needs to pay you the equivalent of interest at the same time that that you're owning a piece of the pie. It can build up to a lot of money. In fact, we have an economic example that I left in these slides that shows that it can become a significant part of a not very good exit. By the time the VCs are in, they tend to be, maybe by Series B, they tend to be turned on because people think, why not? I don't know. Do you see them turned on in Bs or in later rounds, Christopher?
Dividends they are greedy, as Jean points out, and they do set things into effect. For example, a cumulative dividend basically in a lifestyle company gradually shifts ownership from common to preferred because this dividend is accumulating in the background. But they can have unintended consequences and act like a poison pill that makes it hard to get the company acquired at all. So we tend not to use them. When we do, it's low single-digit percentage, like 3 or 4%. It's non-cumulative. Occasionally, when lifestyle company is the biggest risk, we might look at it. But as a general matter, angels don't do a lot with dividends.
Yeah. So somebody's got a question on here about what percent of deals go down in value at some point, and I think it's probably fair to say that, yeah, that in many cases, a either a company's going to go down a little bit and everybody's going to suck it up and keep it going, or it's going to go down a lot, in which case it's dead. And so, what percent? Well, it's all over the map. It depends on sort of your selection and how you're selecting companies.
I would say probably with a typical portfolio, probably something like half of your companies are going to generate all your returns and half of your companies are going to fail. And of the ones that fail, probably 60% went down on their way down the drain and people tried to save them and then it didn't work. And of your winners, maybe 20% might have had a little repricing hiccup somewhere in their history, but they survived it and went on. And if you add that up, probably some non-trivial percentage of deals will see a downward adjustment. It's a kind of a fact of life, but it's definitely to be avoided.
Yeah. We try to avoid it.
We try.
So I'm going to have us, because of time, I'm going to have us not try to walk through this example that I had in here from the slides from the past. But basically, these are things where liquidation preference has been set, dividends have been set, and then somebody's looking at what the exit is. And pretty much what it shows is that if you've got the liquidation preference on and you've got dividends on, that a lot of the money coming in at an exit goes all to the investors and not to the founders. It is possible to carve out a small amount of funds for the founders if you want in one of these non-great exits. So this is the thing where somebody did these slides that said, awesome, the company is sold. If it's sold for $2 million and people had put $1.5 million in, what ended up happening, and this shows that dividends are on, and so the investors got all of it. In the second scenario, there's a transaction cost, and then the preferred, and then the funds. So the amount that's remaining to be divided up, however the pie was defined at the time that we looked back at that pie, that said, what percent is common, what percent is preferred, and so in this case they're saying that 40% of the pie was owned by the preferred. So that last 7,700,000 there would be divided 40% to the preferred and the rest to the common, and so on across the page. So really it just shows that you can have pretty good impacts. You think, well, it sold for more than the money that had gone in, but you can see in scenario one, the founders were very unhappy. In fact, they might have held up the deal. So we're kind of over to a summary on term sheets, and sort of say that in summary, really, the term sheet sets the initial valuation, talks about the percent ownership. It sets other terms that are sort of defining what's going on. In general, you're trying to look at the amount of investment risk. So a company that's priced quite low, it hasn't proven out all of the things that cause risk. It hasn't proven that the product works. It hasn't proven that that it knows how to sell it. It hasn't proven other things. And then later, the company will be priced more. Why? Because it's proven that it knows how to grow and really scale itself up using the money that it's bringing in to grow faster and faster. So those are all the sort of nuances around term sheets.
This next slide, Jean, I think could be summarized by saying you really don't want to get greedy when you're an angel because you hurt yourself. If you put really aggressive terms into a deal, you set three very bad forces in motion. One, you hurt the economics of the founders who you want to work 80 hours a week to make the company a success. Number two, you can scare away future investors who you really need to help you finance the company because they look at it, they go, I don't want to invest in a company with greedy investors who are getting a special deal. Or number three, they come in and they say, actually, I like those terms. I want them too, except now, instead of those terms being applied to $1 million, they're applied to $10 million. And so, or whatever the larger later round is. So as you build this capital stack of privileges, it's like an inverted pyramid, and the later rounds are bigger. So if you introduce greedy terms at the beginning, they just get worse and worse and worse.
They trickle up.
The whole ladder. Or unusual terms too. Don't stick anything in there that's really out of whack, because later rounds don't like to clean up those messes either.
Our job is to put together fair and reasonable vanilla term sheets that fairly allocate all these crazy risks in a way that is going to look familiar to everybody and not give anybody brain damage. Okay,
so I think I have myself on the convertible notes, so I'll talk some more. Let's see, convertible notes. This is really a way of doing a loan to the company. It usually is a loan. You end up with something that says, what is the note holder agreement? But it's also in essence, a promissory note that says, hey, in a year and a half, this note should come due. Now, in point of fact, you're really not trying to have a loan. You're trying to have an agreement that says we really do want this company to be able to raise money. So we want to get this in now. In some cases, it's a story about, the angel group is looking at the company, and, instead of, 40% of the group saying, wow, that's pretty interesting, only 10% are saying it's interesting because there's still things to be proved. So your crazy early people can invest on a convertible note, and then when the company comes along and proves that it can do it, the rest of the group can come in on a more fair on a priced round. There's a number of different things that tend to get put in these. They tend to have they're often called a convertible with a cap. And the cap is setting a price at which, if for some reason the company raises money higher than that price, then the investors will get to invest at that price. So it might say, if the company goes out and raises money and the pre-money valuation on that upcoming future round is higher than $2.5 million, no matter what happens, I'm going to get to buy my shares at $2.5 million, as if it had been priced at $2.5 million. There's lots of little details in convertible notes, just like in these term sheets.
The key point is that they're a little easier. You remember how we talked about having to go down to Delaware and create that updated charter and put all these preferred stock rights? These don't require you to do that. These are just a simple note agreement that says, I'm going to give you some money, you're going to pay me some interest, and you're probably going to convert it into stock at a future date. And it's a little easier to paper up, a little bit cheaper. It doesn't require a trip to Delaware, and it does allow you to avoid having to agree that the company's worth $3 million, for example, in that other example. If it's 2 engineers, a PowerPoint, and a dog, and they haven't really done anything yet, it's going to be, and you value them at what they're really worth, which is $250,000, and you give them $500,000, guess what? The investors automatically own 2/3 of the company, right? So the convertible note allows you to get a little bit of money and kick the can down the road and get started and create a little value before the deal gets papered up as a priced round.
It's
and
also
you knew that question was coming, Jean. Valuation question was coming. So speaking of kicking it down Portsmouth asked if, short of a formal valuations, how do you assure fair valuation as the investor? The answer to that one is you kind of go, you're worth about here. Valuations are.
I'm trying so hard not to say anything.
So
there are. Yeah, go ahead, Jean.
Valuations are black art. And you need somebody in your angel group who wants to learn the magic of that black art, but you don't need to know it. What you need to know is that the group is agreeing that this is fair, that both the investors and the entrepreneurs are a little bit hurt. There is no absolute way to value a company that doesn't have revenue and doesn't have a potential of any kind of exit at this point in time. So you're guessing into the future what the company's going to be like. Sometimes there's something that is tangible. This is a medical device company and they have a patent. That patent is probably worth something in its own right. And the fact that these people want to build a company around it is also worth something. We're going to add those two together to get to the valuation. But there's, as opposed to public companies that are trading on Wall Street or trading on Wall Street who's going up and down this today, I guess, there is no cash flow based way of doing a valuation. There's no other way of doing it because it doesn't exist yet. This is, it's a black art that a small number of people are involved in.
Yeah, there are some cheats and there are some ways to know that you're kind of getting an okay deal. I mean, obviously what you're trying to do is you're trying to look at how much money they're raising and what they can accomplish with it, and whether that with that level of accomplishment, they can pull off a round in the future that is as high or higher than the post money on your deal. So we talk a lot about pre-monies, but we think a lot about post monies. The other thing to kind of keep in mind is that of the 70,000 angel deals that get done in the United States every year, the vast majority of those deals, the investor class, the group of investors is going to end up owning between 20 and 30% of the company on a post-money basis. So 1 million on 3 ends up owning you 20%. 1 million on 2 ends up owning you 33%. And so you can get a pretty good sense of whether a deal is expensive or cheap just by looking at where it ends up in that range. And I've done a ton of writing on this subject. If you want more detail, we don't need to get into it here. But if you're interested, look up some of the stuff I've written on it, and you can find a lot there.
Christopher's got not only books but blogs on Inc. magazine and also on Seraph. So he's everywhere.
He's very prolific.
Yeah.
And how seriously do we concern ourselves with valuation caps and a convertible note? Those have become standard almost on all convertible notes that I've seen. There's been a cap. So yes, you do. And part of that is because it's standard. If you're going to shop it around to other people, they'll expect it. So we usually do put it in, especially if you can't raise it within a certain group of people and you're going to have to take it to maybe other people in the area. And if it's out of whack with industry standard, that's a flag. It's either a sign of a very stubborn entrepreneur or of a sign of an entrepreneur who isn't educated around what's standard.
Or an entrepreneur who's been to Y Combinator.
Yes. who's read all sorts of articles about that company that raised $1 million on $10 million pre-money valuation.
The cap is a pricing signal, and it does matter, and it's a very inexact pricing signal, and it's one of the challenges with notes. If it's too high, it's not going to do the investors any good, and it may scare other people off, and it may make people question the judgment of the entrepreneur. So you do kind of have to get the caps right. Yeah.
But on the other hand, if the new investor comes in a little bit below it, you're protected. So it's not really that important, but you also don't want to signal that the entrepreneur is going to be incredibly disappointed if the new investors don't come in above that. So it's a big signaling issue, and you spend a lot of time on it, even though, it's a big signaling issue. So you have to be careful with it. Okay, so again, our friends in California decided that they could outdo anybody. So they wrote up a thing that they call a SAFE, and it's a class of convertible note that's not debt, but instead is a promise to give you equity in the future for the money that you've provided, and it has the same effect as a convertible note. Except for that there is no actual debt that has to be written off. Usually in hey, the convertible notes are coming due. What are we going to do? We have to write them off. We have to extend them, etc. In a SAFE, if they're coming due, they just go away. So they have a slightly just sort of less space around them in the world. They're kind of new. They don't have case law around them very much, and they're not very popular in New England, but somebody will come running back from California with one.
Or they'll read it somewhere and they'll be like, I want to do the safe thing. And
they're basically just a warrant, and they really are a raw deal for investors. And so most of us rarely plug our nose and do safes unless it's an extraordinary situation.
So trends. Yeah. So trends. So we've been talking about trends as we've really gone through this, which is sort of what you historically see and then what you're seeing these days. And as we've gone through, we've really been talking about most of these. Angel deals, typically you'll see variations across the country, definitely coast to coast, as we were just talking about. California, you'll see safes, you'll see more traditional term sheets in New England that typically follow the NVCA fairly closely. Launchpad has a couple different versions of term sheets that they use. So that it's not quite that standard. VCs tend to stick pretty much to the playbook of the NVCA, and they'll modify it as necessary, but they stick to it. We'll base some things on trends that we see there, but usually it's regional, very specifically regional in some cases. That also goes for valuations. Valuations are very regional. Evaluations are much higher in California and New York than they tend to be here. Part of that depends on demand and the amount of money that can be put to use. We also tend to be really conservative here in New England about all sorts of things, including valuations. And a lot of that's based on just experience. We know where you're going to be able to end up, and so we tend to be on the lower end of those scales. So you get variations there. There is a trend to move towards this, as we said, more vanilla. The more vanilla you can make it, the better the easier it is for everybody. So you're seeing more standardized term sheets around liquidation preference, anti-dilution, board and information rights. And sometimes those will shift, right? There was a time period when liquidation preferences were going through the roof. And then they calm back down. The anti-dilution is pretty standard now. Board and information rights are fairly standard, though you may see some variations, and along with participation rights. So you're seeing more standardization happening. But as I said, those changes have occurred. So they go up and down a little bit. Full ratchets almost completely disappeared. And as we talked about redemption, we talked about registration rights. And as Jean mentioned, convertible notes are in unless they're out. And some investors are very specific about it. Some will won't invest in any convertible notes. We will only do equity. And some will do a combination. I personally do I'll do either, depending on the stage of the company. All three of us tend to do, well, Jean and I especially tend to do very early seed stage, help the company get to a funding round. And so we will do convertible notes. And NBCA has been pretty standard since we started using them. When my father started investing back in the late 80s, early 90s, he was doing mostly just common. So these preferred term deals, we didn't see as much until the 2000s, and it's been pretty standard for quite a while. And Vermont is wondering if we can speak to our own portfolios. Why don't we hold that one until near the end?
Yeah, I think we've only got about 2 or 3 more slides. So I'll just do 38, slide 38 really quickly. Yep. Series Seed versus Series A. Well, what do we call them and why? Well, there's no reason what we call them. We just need to call them. And in general, what's happened is that people start saying that a Series A done by a professional venture firm is requiring that a company have over $1 million of revenue and that it be repeatable revenue. And therefore, the Series A players are talking about putting $5 million in. That would have clearly been a Series B just, 12 years ago. But right now, we call it a Series A, and in many cases, a deal where you're only raising about $1 million for a company or $1.5 million will be called a Series Seed. And that's just what they're called. And as Christopher said, you could call it a Series 1. It doesn't matter. During the economic downturn, the Jobs Bill created another class of exemption to the Securities and Exchange rules called the 506C. And this was the idea that we should be able to open up angel investing to even people who aren't able to be considered accredited investors. And so there's a complex set of rules. You have to go through a platform that manages the investment. But in this investment, you can advertise it more widely. You can tell people that you're raising money. In general, for a 506B, you're supposed to be only talking to small controlled groups, like presenting to an angel group. 506Cs can be quite costly as a cost of money because there's so many processing costs that have to be filed every year that are pretty expensive. And it's very unlikely that those of us who are investing in 506Bs, angels, VCs, etc., are going to try to mix the two because the shareholder rights are too complex. And so as a whole, we just say, let's not go there. We don't understand it. If you're going to go there with a platform you truly trust. And then I think this is an okay place where each of us could say a minute or two about our own portfolios. You want to start, Christopher?
Sure. So I'll cite some broad statistical. This is an understudied area, and it's a hard area to study because it relies on sort of self-reporting. But there have probably been a half dozen studies of angel investing done over the years of varying quality, and most of those studies kind of coalesce around the idea that angel capital can return an IRR in the mid to high 20s. So there's a little bit of consensus about that, but there are some really important footnotes in terms of how to get there, right? So working out of a really good deal flow, having a good process, doing a really significant amount of diligence, and understanding, recognizing the outsized importance of 1 or 2 deals to really help you drive your returns. A good way to think about it.
Or even having a portfolio at all, right?
Yep.
This is going to be an averages game. Invest in one company and hope it to return great for you. Doesn't happen.
That's like winning your first hand of 21. So most people really approach this from the perspective that you really do need to build a portfolio of investments that represent different kinds of deals across different dimensions. And a good way to think about it is if you invest in 10 companies, 5 will fail outright, and you just need to be prepared for that. One might generate a 10x, so now you're at break even because that one deal has returned, everything you put into the 10 companies, and how well you do from that point forward really is a function of the remaining 4 companies. Are they all fast, good 3, 4, 5x's, or are they all kind of slow 2x's? And your IRR will be a reflection of that. So in my own time as an investor, I've probably done somewhere in the neighborhood of 65 or 70 companies. And I've had somewhere in the neighborhood of 20, 22, 23 exits, and they fall pretty much along those lines. About half those exits have been positive, and about half those exits have been negative. And right now, if you look at sort of my the valuation of what I hold relative to the basis, I'm sitting on a portfolio that is somewhere between a 2 and a 2.2x. And if some of those companies do well, I could end up with a decent return on the overall portfolio. But there's a lot of baseball that has to get played yet. So this is a game for the long haul. This is not a liquid asset class. This is more like adopting a puppy than buying a lottery ticket.
That's a good way of putting it. Yeah, the return, there was a push, I think, at one point to get quick returns from companies, but vast majority of my companies I've been holding for 5 to 7 years. Usually the ones that flame out, luckily, tend to flame out early, not always. So that's kind of nice. It gets kicked off your you can take the loss earlier on. I mean, we have one company that my father invested in 1990 that we still actually own the majority shares of. And he is still eventually looking for an exit. It's grown significantly, don't get me wrong. So there's all sorts of different examples of all sorts of different stuff. But this is not a quick return. It's typically long, but it can be definitely very, you can get some very good returns, and very decent exits on some of those. So our portfolio is probably actually greater than 2.5. I'd say that we're on our exits, on what we're holding, it's probably closer to 8 to 9 right now. But that's partially because we haven't, some of our duds flamed out really early.
So I'm the crazy person here. I do a lot of really small investments in really early companies. This idea that if 5 of us can each find $5K for that company, they'll be able to prove that, or they won't, and just sort of see how they can get through, and in many cases, some of those real early ones go away, and I sometimes am actually thinking about them as a separate sort of early portfolio. So how much of my total money do I have in the earlies, as a way of thinking about it, which is a little bit crazy. I had the absolute dumb luck of the very first company that I ever invested in returning 17x on my investment, and I had quite a bit of money working. That was Zipcar, and so who knew? Absolute dumb luck. But not really. I really did an amazing amount of work, but that exit rate for me was quite unusual. And so, but on the other hand, I have a lot of money in the market with a large portfolio. So it's just sort of what it is. I tend to think in multiples. Hey, if I'm looking at a company and I'm pretty sure it's a 2 to 4x company from where we are right now, I'm a pretty happy person. And so that tends to be the way.
Yeah, a good benchmark is a top decile VC fund will generate a 3x on the entire fund, right? So if you can get an angel portfolio into the low to mid twos, you're probably in the neighborhood. Mid twos, you're in the top quartile of VC performance, and 3x would get you into the top decile. So it's definitely a game where you have to make a lot of bets to pay for all your mistakes.
Okay, so we have sent you a term sheet that a lawyer marked up in the past. It's a slightly older version of the National Venture Capital Association term sheet, and he color coded the different sections, which was kind of cool, because it really made kind of a neat way to look at the to look at what was going on, and so that's actually a really helpful item to look through. If any of you want to ask questions in a way that you can get into a discussion, tell us and we'll unmute you so that we can do that. And we definitely have a few minutes to do more questions of any type. And so again, okay, so we have, it takes that much investing for, well, I think the important thing in building a portfolio is don't try to do it too fast, right? Work on the idea that if you're involved in 2 to 3 investments, 3 to 4 investments, maybe even a couple more, if you're involved in the 4 investments a year, you're probably moving at a speed that you're learning, you're getting your comfort zone up at a level of understanding what fits your risk profile and what works with your group, as a good thing, and also having the group be brave enough to say no a few times. We just don't understand this industry. We haven't figured out how this company's ever going to have an exit, whatever it is. Those are all something to talk about too. There's also a question about the range of investment size. Down here, Boston, a lot of 25K people. I don't know why it is.
Yeah, I'd say that it's less about average check size and more about common check sizes. 10K is usually sort of the smallest check size you see because it is kind of a pain in the ass to process an investor and carry them on the cap table. So most people sort of, unless you can find a fund that allows you to divvy the checks up smaller, most people would say that 10K is really the smallest check you could write. And a lot of people who are thoughtful about portfolio building would advise you not to go over about 25K, because if you do the math, let's say you need to do 10 investments, and let's say on average you put $1 in follow-on money in for every first round dollar you put in, which is a pretty good guess. You don't follow every company on, but some you follow on more. So if you're doing a 10K check and another 10K check on average for each of those companies, and you're trying to get to 10 companies, you're basically talking about $250,000 just to kind of be in the asset class as a good benchmark. And obviously that needs to be a small and manageable portion of your investable net wealth. So a lot of times we'll see someone come into the angel market and they're raring to go and they want to write a 75K check to the first company they meet, and they really don't understand portfolio mechanics. They really don't understand diversification. I will beg them to write 7 10K checks to 7 interesting companies over the course of their first year instead, because it just doesn't work out well from a diversification perspective to get too big for your britches too quickly.
It partially just depends on your own personal capacity. And as Christopher said, if you've got a certain amount of money that you've got set aside to do these investments, assume that you're going to make a certain number of investments and divvy it up that way. Sometimes you'll want to give a little bit more. Sometimes you want to give a little bit less. But everything, it's like everything is a shiny toy when you first see it, when you first start. Like every company looks interesting. Oh my God, that's so cool. Oh, that's amazing. And the longer you're in it, the more you realize that there's some things are repeat business that you've heard before. So sitting back and listening, and as Christopher said, maybe doing smaller investments initially until you get your feet under you is always a wise advice.
I'm a big fan of the idea that that what angels are investing is capital, but they're also investing
people
as a group, human capital. And so the people that are going in to help companies often make a huge difference. So making sure that that the startups have the right kind of support increases your odds that you're going to get some kind of return instead of just have to write it off. And so I think that's another important one.
I'll make a quick comment on the follow-on question, dry powder question. Imagine the miracle of being in a situation where you're an insider for a really hot startup that's about to take off. That's the scenario you're trying to manufacture with your angel investing, right? You're making lots of small bets to meet lots of companies and get a seat at the table. And your follow-on strategy is really to pile money into the companies that are doing well. The deals are a little bit more expensive at that point because they're de-risked, but you understand whether the CEO is a good steward of capital. You understand whether the dogs are eating the dog food. You have a lot of insights. And so most angel investors recognize that a really, really important part of their portfolio is following on in their winners. Not every company is going to be a winner, and unfortunately, you're going to get asked to follow on in many cases before it's really clear. So a good rule of thumb is to think about $1 in follow-on money for every dollar in first-round money. And another rule to keep an eye on is the average amount of money into winners versus the average amount of money into losers. You're probably not in the ball game if your average amount of money into winning companies isn't at least 2x the average amount into losers. And in a perfect world, it might be 3 or 4, even 5x. Following on is important, but it takes time to sort of have winners to follow on into.
Yeah,
after you have a really bad feeling, following on for a long time is a really bad
idea. You learn really quickly to kind of trust your gut on some of these too.
And admit you're wrong.
Yeah.
Just admit it. Just stop writing checks and admit you're an idiot and move on.
Gee.
Christopher was telling me to admit I was an idiot.
No, I'm telling myself I'm an idiot. I mean, how many times have we written a check because it's easier than admitting we were wrong in the first place?
Hey,
I do it all the time.
Do you want to take the tax question that's on the screen?
Yeah.
Yeah. So for the most part, one of the nice things about doing a priced round versus a note is that you can get capital gains treatment. For the most part, these are there are some nice tax advantages to this. Generally, we're buying stock in a company, we're holding it for long enough to qualify for capital gains, and that's the main thing. One of the other things is when it fails, we have a cool provision called 1244 that allows us to write the loss off against ordinary income. And we do have the ability to not pay any tax at all in deals that are eligible under Section 1202, which means that we got in early and they were young and we held for a long time. So it's another topic I've done a lot of writing on. If you want to know more, people can just send me a note or whatever, and I can send links to people or whatever.
Well, and each individual doesn't need to know all the implications. What they need to know is the list of things that they need to look through, and then as a company has an exit of any kind, figure out what it is and collect those tax write-offs, because you're going to have a few.
Yeah, you will. Always just be aware of that as you're going through it too.
If you're not falling down, you're not skiing fast enough. So you just got to get the snow on you, brush yourself off, and keep going.
Well,
other questions?
How are you folks out there? Are you dying? It was we agreed in advance that it was one of the densest, most horrible set of things that we could possibly do to somebody, was to try to talk to them about a term sheets in the afternoon. But how do you find deals? How do they find you? Oh, that's a fun one. You want to start, Chris?
Yeah, it's odd if you run a flag up a pole that says I have money and I give it to crazy people, they come and find you pretty quickly. But the answer is you got to look at a lot of deals to learn what a good deal is, and just to develop deal flow and meet people. I find deals by cheating. I have a whole bunch of members in my group who go out in the community and interact with startups and bring the most promising deals back to the Honeycomb Hideout. But basically, the answer is get involved in your ecosystem and meet a lot of companies.
Yeah, and one of the things for you folks to look at maybe for a couple of the first deals is to definitely attend some of the regional deal sharing meetings, because it will mean that it's a company that another angel group is at least in due diligence with and is planning to give a term sheet to. And that means that it's something that other people are paying attention to and helping grow. And so to take a look at those companies as a practice for how to do diligence, as a practice for how to think about deals, and then to maybe consider as one of your early deals, because it will be a way to sort of get into the slipstream. And as was mentioned earlier, New England, we have lots of small angel groups, and we're great at cooperating.
Yeah.
In California, they have an angel group that goes all the way from Santa Barbara to San Diego, and it's gigantic. But then they're not so practiced at the kind of cooperation we have to do across between different groups.
Though to all of Tech Coast and Kretzer, they to sometimes act separately as well. But networking is really the best way to do it. The advantage to being in Boston, of course, is that there's a ton of different events that go on a regular basis, and a ton of organizations that are reaching out to startups all the time. And so you can, for angels here, we can hang out at those events. But Jean's right. If you start hanging out, or at least reaching out to some of those ecosystems, it's probably the best way. I mean, some of my biggest, the deals that we've, been the most involved with have been ones that have come through my own personal pipeline, through friends and family or family. Sometimes they're just out there and they find you.
Well, and again, I think part of the idea here is that we're really excited that the states that don't have as much angel activity going on are growing new angels, and you will grow more entrepreneurs, or entrepreneurs will find the fit with you as a result of being there. So that's a good thing, because we need entrepreneurship out there in the communities, addressing the issues that the communities are facing. And again, you'll find a mix of companies, the ones that are going to be able to grow up and grow fast enough that they can have an exit in the future. Won't be all of them. You'll see a lot of companies that are much more slower growth companies, but there's nothing wrong with them. They just don't fit the normal way of doing angel investing. Okay. Besides being exhausted, how are people?
Everybody knows everything they need to know.
We've got a few people that are thumbs upping it.
A couple people in Portland are resting on their elbows. We may have exhausted them.
All good. It's a lot to cover, and it's very dense. And it's hard to do in one session. So an overview is what we were trying to get across to you as much as possible.
I will say, as dense as it is, this is the funnest thing you can do. I mean, this is angel investing is so meaningful for your communities and for creating opportunity and jobs and national competitiveness and using the skills and continuing to be a lifelong learner. There isn't much out there that's more rewarding than getting involved in this. So it is worth the pain of getting up the learning curve.
It's a lot of fun. It's really interesting to hear what people come up with too. I mean, it's fascinating, absolutely fascinating to hear what people and what types of companies that you can invest in as well. And it runs the gamut. It's not just tech. I have a company up in Lawrence that's a clothing manufacturing company. Contract clothing manufacturing company that I've invested in too. You can find all sorts of different things.
And how about your fish food company?
And my fish food company up in Lowell, up in the Merrimack Valley. So there's all sorts of really cool, fun, and all of Jean's ed tech companies. I mean, there's really interesting things that people are coming up with. And you get to support them and see their passions and their visions grow. It's really cool.
Okay, so is somebody going to tell us what to do? Oh, somebody told us thank you. Oh,
You're very welcome. It was our pleasure.
Our pleasure.
Is there a way to get a return and also state economic? Oh, yeah, that's right. That's right. It's a philosophy of trying to support growth that can work for your state and your region and for all of us at some level.
I don't know about you people, but I don't think my kids are going to get a job at a big corporation and work there for 40 years and get a gold watch. I think entrepreneurship is really a big part of our economy nowadays, and I'm glad to be part of entrepreneurship.
And as I said, there's entrepreneurs who are trying to do all sorts of things. Like I said, I invested in a company up in Lawrence it's a manufacturing company that's trying to sort of bring textiles back into Massachusetts. And there's companies like that around too that can still be high growth companies that are really making economic impacts on their communities.
Okay, it looks like people are telling us that we can go away. Is that?
They're sick of seeing our faces.
It's Miller time, Jean.
All right,
everybody.
ladies.
Thank you.
Wants to do a close. Actually.
Oh, Portland wants to do something. So what are we going to do? How about if I just unmute all? Is that the right one? Oh no, Ellie's going to make it so that I don't do something technically
Infelicitous.
Yeah.